In this session, we're going to look at the key financial ratios that help you understand a business properly, not just the numbers, but what they actually mean. We'll break it down into three areas: profitability, liquidity, and efficiency, so you can quickly assess how a business is performing, whether cash is healthy, and how well it's being managed. Profitability ratios. One of the most important tools used in financial analysis. Profitability ratios help us answer a simple question: how good is a company at making profit? Investors, managers, banks, and analysts all use these ratios to understand whether a business is performing well or poorly. Profitability ratios measure business performance, show efficiency, help investors compare companies. A company can have very high revenue but still be poorly managed. For example, imagine two companies that both sell £1 million worth of products. One company earns £200,000 profit. Another earns only £20,000. Even though their sales are the same, their profitability is very different. Profitability ratios help us identify these differences. In this lecture, we'll focus on 5 key profitability ratios: gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. Together, they give us a clear picture of how efficiently a company generates profit. Let's start with gross profit margin. This ratio shows how much profit a company makes after covering production costs. The formula is gross profit divided by revenue. Let's look at an example. Suppose a company sells products worth £500,000. The cost of producing those products is £300,000. The gross profit is therefore £200,000. When we divide £200,000 by £500,000, we get a gross profit margin of 40%. This means that for every £1 of sales, the company keeps 40 pence after production costs. Next, we have the operating profit margin. This ratio goes one step further than gross margin. It includes operating expenses such as salaries, marketing, and administrative costs. If the company has £80,000 operating profit from £500,000 sales, the operating margin is 16%. That means the company keeps 16 pence from every £1 of sales after operating expenses. The net profit margin shows the final profitability after all costs, taxes, and interest. In our example, the company earns £50,000 net profit from £500,000 revenue. That gives us a net margin of 10%. This means that after all expenses, the company keeps 10 pence from every £1 of sales. Return on assets measures how efficiently the company uses its assets to generate profit. If a company earns £50,000 profit and owns £400,000 in assets, its return on assets is 12.5%. In simple terms, every £1 invested in assets produces 12.5 pence of profit. Return on equity measures how well the company uses shareholders' money. If shareholders invested £200,000 and the company generated £50,000 profit, the return is 25%. Investors often pay close attention to return on equity because it shows how effectively their capital is being used. One very important rule in financial analysis: never analyze ratios in isolation. A ratio only becomes meaningful when we compare it with previous years, competitors, or industry averages. For example, a 10% margin may be excellent in supermarkets but very poor in software companies. Profitability ratios help us understand whether a business is successful at generating profit. They show us how efficiently the company operates and how well it uses its resources. In this video, we will discuss liquidity ratios, one of the most important areas of financial analysis. Liquidity ratios measure a company's ability to meet its short-term obligations using its short-term assets. In simple terms, they answer the question: can the company pay its bills in the next 12 months? Liquidity analysis is important for banks and lenders, investors, suppliers, management, and credit analysts. These stakeholders want to know whether the company has enough liquid resources to operate safely without running into financial difficulty. Liquidity ratios are calculated using figures from the balance sheet, specifically current assets and current liabilities. The three main liquidity ratios used in accounting and finance are current ratio, quick ratio, and cash ratio. The current ratio measures whether a company has enough current assets to cover its current liabilities. Current assets are assets expected to be converted into cash within 12 months. Examples include cash, bank balances, accounts receivable, inventory, and short-term investments. Current liabilities are obligations due within 12 months, such as trade payables, short-term loans, accrued expenses, and taxes payable. The formula is current ratio equals current assets divided by current liabilities. Assume a company has current assets 200,000, current liabilities equals 100,000. Current ratio equals 200,000 divided by 100,000 equals 2.0. This means the company has £2 of current assets for every £1 of short-term debt. A current ratio around 1.5 to 2 is often considered healthy. If the ratio is below 1, the company may struggle to meet its short-term obligations. If the ratio is too high, for example above 3, it may indicate inefficient use of assets, meaning too much cash or inventory is sitting idle. The cash ratio is the most conservative liquidity ratio. It only considers cash and cash equivalents. Formula is cash ratio equals cash and cash equivalents divided by current liabilities. Example: cash is 40,000, current liabilities 100,000. Cash ratio is 0.4. This means the company can immediately cover 40% of its short-term obligations using cash. A cash ratio is usually lower than other liquidity ratios because companies normally invest cash into operations rather than holding large idle balances. Liquidity ratios should always be analysed together with cash flow analysis, industry benchmarks, and historical trends to obtain a complete picture of a company's financial health. Why do some businesses run out of cash, even when they're profitable? The answer often comes down to efficiency. In this video, you will see how efficiency ratios reveal how well and smartly business actually operates, using its resources to generate revenue. Efficiency ratios measure how effectively a company manages inventory, receivables, payables, and assets overall. Let's start with inventory turnover. This tells us how many times a business sells and replaces its inventory during the year. Inventory turnover equals cost of sales divided by average inventory. Let's say cost of sales equals £100,000. Average inventory equals 20,000. Inventory turnover equals 100,000 divided by 20,000 equals 5 times. This means the business sells its stock 5 times per year. Higher is better. Stock moves quickly. Lower means problem, slow-moving or obsolete stock. Inventory days formula is average inventory divided by cost of sales multiplied by 365 days. Example: 20,000 divided by 100,000 multiplied by 365 days equals 73 days. It takes 73 days to sell inventory. Let's talk about the receivables collection period, one of the most important efficiency ratios. This ratio answers a very practical question. How long does it take for a business to actually receive cash from its customers? Because making a sale doesn't mean getting cash immediately. Now, we calculate it using this formula. Receivables days equals trade receivables divided by credit sales multiplied by 365 days. What we're doing here is converting receivables into days, so we can understand the delay in cash collection. Let's say a company has trade receivables of £15,000, credit sales of £90,000. So, receivables days equals 15,000 divided by 90,000 multiplied by 365 days equals 61 days. This means, on average, customers take 61 days to pay. Now, the key part is interpretation. A lower number of days is good, means customers pay quickly. Strong cash flow. A higher number of days is risky, means customers delay payments, cash is tied up, possible bad debts. However, we must never interpret this in isolation. We should always ask, what is the company's credit policy? Is it 30 days or 60 days? Has it increased compared to last year? How does it compare to industry averages? For example, if the policy is 30 days but customers take 61 days, that's a serious control issue. In real life, a high receivables period can create major problems. The business may struggle to pay suppliers, it may need loans just to survive, profit may look good, but cash flow is weak. So this ratio is critical for liquidity, not just performance. The receivables collection period tells us how efficiently a business turns sales into cash and whether its customers are paying on time. Now let's talk about the payables payment period, which is how long a company takes to pay its suppliers. In simple terms, this ratio tells us how quickly, or slowly, a business pays suppliers it owes money to. The formula is payables divided by purchases multiplied by 365 days. So what does this actually mean in real life? If a company has, say, 45 payables days, it means on average it takes about 45 days to pay its suppliers. A higher payables period can actually be a good thing. It means the company is holding on to its cash longer. That improves cash flow and gives the business more flexibility. But there's a limit. If the number is too high, it could signal problems. The company might be struggling to pay suppliers, or it could damage supplier relationships. Suppliers might stop offering credit or demand cash up front. On the other hand, a low payables period means the company pays suppliers quickly, that builds strong relationships, but it may hurt cash flow because money leaves the business faster. This ratio is all about balancing cash flow and supplier trust. A smart business doesn't pay too early, but also doesn't pay so late that it creates risk. Next ratio is the cash conversion cycle, which measures how long it takes for a business to convert its investment in working capital into cash flows from customers. In simple terms, it shows how many days cash is tied up in the operating cycle. The cash conversion cycle is calculated as inventory days plus receivables days minus payables days. Each component reflects a stage in the working capital cycle. Inventory days measures how long inventory is held before being sold. Receivables days measures how long customers take to pay. Payables days measures how long the business takes to pay suppliers. The cycle begins when a company purchases inventory, often on credit. This inventory is then held for a period, which is captured by inventory days. Once the goods are sold, typically on credit, the company must wait to receive cash from customers. This is reflected in receivables days. Finally, the company delays payment to suppliers, which is measured by payables days. So overall, the cash conversion cycle represents the net time between cash outflow and cash inflow. A shorter cash conversion cycle indicates that a company is efficient in managing its working capital. It recovers cash quickly, which improves liquidity. A longer cash conversion cycle suggests that cash is tied up for a longer period, which may create liquidity pressure. In some industries, such as retail, companies may have a negative cash conversion cycle. This means they receive cash from customers before they pay suppliers, which is a strong liquidity position. Let's look at a simple example to understand how the cash conversion cycle is calculated and interpreted. The company holds inventory for 40 days before selling it. After the sale, it takes another 30 days to collect cash from customers. However, the company paying suppliers earlier. So overall, cash is tied up for 50 days between paying suppliers and receiving cash from customers. Paying suppliers earlier reduces payables days, increasing the cash conversion cycle and weakening liquidity. Let's look at another example. Delaying payment increases payables days, reducing the cash conversion cycle and improving liquidity. An increase in receivables days increases the cash conversion cycle, significantly worsening liquidity. If customers take longer to pay, receivables days increase, lengthening the cash conversion cycle and creating liquidity pressure. The business may respond by increasing payables days to delay cash outflows and partially offset this effect. However, this strategy has limitations, as it may damage supplier relationships and does not address the underlying issue. Therefore, the business should also improve receivables management to reduce the cash conversion cycle effectively.